Hey everybody, thanks for joining us again today. Blake Ragland here with Bradshaw and Will. I'm with Brandon Morgan, our certified financial planner once again. And today we're going to be talking a little bit about market volatility. So Brandon, do you want to take it away from here?
Thank you, Blake. On our last video, we discussed sequence of return risk. And what we talked about was there are two completely different phases for investing, the accumulation phase and the distribution phase. And in the video, we showed we had two sample returns in accumulation that were in inverse order of each other.
Correct.
And at the end, we ended up with the exact same amount of money, right?
Yep.
But when we went to distribution, drawing money out, we had the same returns over there in inverse order, but the ones that were negative first did a lot worse. In fact, I think we ran out of money.
We did
a lot worse in that one. So that's sequence of return. The key there is you don't want negative returns early in retirement. But you noticed on the one that started with the positive returns that I believe it was averaging 6% return, and we were taking out 6%, but we ended up with less money than we started. So obviously that's not the sequence of return risk. That is what we call volatility risk. And basically what we're talking about here is the more that your investment varies from the average or the mean, the less your overall return, okay? Let me give you a quick example.
Okay.
Let's do some simple math here. Say we have $100. Year one, we make 50%. How much do we have?
Year one, we make 50%, so we'll have $150.
Exactly. Year two, we lose 50%.
So 150 divided by 2 would be 75.
Very good. Good math there. So if we're a mutual fund company, we would advertise a 2-year average of 0.
Right.
We would say we made 50, we lost 50, broke even. Now let's do it reverse. We started on the positive that time, right? So if we say $100 and we lose 50%, how much do we have?
$50.
$50. Now let's say year two, we gain 50%.
So 50% of 50 is 25, so we have 75.
Exactly right. You're very good with math there. So
Thank you.
Either way, we came up with the same amount, less than we started with. But the average would have said 0.
So you'd think that you would end up with 100 after that, right?
Right. But what we're talking about here is, again, the more we're varying from the average, the less your overall return. So I've written down here kind of an example, just kind of illustrate this out. And on this board, we have $100 with two different investments. Over here, for 6 years, every single year, you get 10% return. So after the 6 years is over, you got $177.11, okay?
Okay.
Now, we go back over here, we have the same $100. We're going to average the same 10%, but we're going to have it more volatile. Plus 25, minus 10, plus 30, and so on. At the end, we end up with $157.67, right?
So it's about $20 less, but
Right.
we, like you said, we have the same average.
Same average, but we have less money because we vary more here, right?
Okay, yeah.
So this is $100, but if this is $100,000, we'd be off $20,000, right?
Yeah, then that makes a big difference.
Even more, we'd be off more, and this is only 6 years. Go more years, it could be even more difference than this.
Yeah.
So that's what we're looking at is the more that you vary from the average or the mean, the less your overall return.
Okay. Well, what can clients do to, take this market risk out of there where you're not getting so much volatility and up and down?
Okay. So let me make this clear. You want to reduce volatility. But we still feel like stocks over the long term are going to have your highest return.
Yeah.
And stocks do tend to have volatility. So you want to look on one hand, maybe try to buy stocks that are less volatile if possible, but also have some investments that are not volatile, that don't have that downside risk. That'll even you out some. So if you have, say, 40% of your portfolio that has no downside risk, you lower the overall volatility of your portfolio. And if you're retired, it's going to be very important that you have some of your assets that aren't volatile because, like we talked last time about sequence returns, you don't want to be drawing from an investment when it's losing in the early years of retirement.
Right.
So the bottom line is we want to reduce the volatility, the amount that goes up and down from year to year. That doesn't mean we're not striving for the highest return that we can get, but we're still trying to get it at kind of as level a return as possible. Does that make sense?
Yeah, that makes perfect sense. I think this is great information for our clients because I know whenever I started and you were telling me about this, and you were saying, hey, over 2 years you averaged 0, but you went up 50 and down 50 after 2 years. You know, I would have never thought that it was 75 after at the end of there. So
right.
I think this is good for everybody watching to realize that, you know, the more you do vary from the mean, then you're going to end up with much less.
Right.
So
one of the things that you could say here is it's the difference between real return and average return. A mutual fund company is going to give you the average return. They're going to tell you they're going to give you the average of 10%. A real return is what you really have left over that you can spend. That's what's important to you, what you really have.
what are some ways that people can reduce this volatility? What kind of tools can they use in their portfolio to help, you know, reduce that downside risk?
Well, within stocks, diversification
Right.
is your greatest reduction. So you want to be diversified, that tends to reduce risk. But then you also want some asset class that has less risk than stocks. Product that we talked about is annuities, index annuities in particular.
Right.
You have no downside risk whatsoever, and typically over a period of time, they have tended to get somewhere between 4 and 7. Now that's not a guarantee. That's kind of a neighborhood that you might look at getting over a period of time. But the key thing there is there's no downside risk. So sometimes when the market's going really volatile and very down, sometimes, you know, the old saying, zero can be your hero is really true. If you can have some years where you just don't lose anything when the market's losing 30, 40, 50%, that can be a huge win.
Well, that's great information. Is there anything else you want to add before we go here?
That's really all I have to say on this today. Is just in retirement especially, it's important to put together a plan where you have stocks for the long term, but you have some money that is less volatile to help preserve your income for as long as you live.
Thank you guys for tuning in this week. Next week, we're going to be talking about an acronym that'll help you guys remember how to have a safe and secure retirement. Thanks.